I did a video discussing my most profitable investment strategy a few weeks ago. I talked about a lot of basics. A lot of you loved when I talk about basics. So in this one, I'm going to discuss 4 big mistakes that stock market beginners make. It's mainly for individual stock pickers. It's not for index fund investors because I don't invest in index funds. So I have no experience with index fund. This is all for individual stock pickers. Stuff you're not going to hear outside of this video. A lot of controversial stuff. But this is just my honest opinion about 4 big mistakes that stock market investors make. Okay, this is the first one, and it's one of the big ones, and it's mainly belonging to a certain camp. You have the mainstream media pushing something called growth stocks, pushing something called value stocks, growth investing, value investing, trading. You're a trader, you're an investor. While you have the best investors of all time themselves not believing in that stuff. Buffett said many times that he doesn't believe that there's something called growth stocks or value stocks. He doesn't even believe in them. And Charlie Munger himself, he said, all intelligent investing is value investing, acquiring more than you are paying for. You must value the business in order to value the stock. For value investors, it's more about a stock being undervalued relative to the present earnings. Maybe there's something wrong with it temporarily, it could be fixed, then the value gets realized. For growth investors, which should be the same, it's mainly paying less than what they believe the stock it could earn in the future. It's the same thing. It's all investing. Even traders that get in and out of stock, we're all the same thing. But you have a lot of people that they hate on each other. For example, over the last 10 years, growth investors have absolutely destroyed value investors. Growth stocks have outperformed everything. Now, there's 2 things we could do. We could hate on them, we could call them names, call them traders, call them all these kind of things. Or maybe we can learn something from them and look for maybe growth stocks ourselves. You could do both things. What I would do, I would try to learn from them. And same thing for growth investors. But you have each other, they call themselves names. Oh, you're a growth investor. I don't invest in those growth stocks. I don't invest in the Cassie Wood stocks, unprofitable junk. And then growth investors say, I don't invest in the dying companies, value stocks. Buffett is a boomer and all these things. Or they hate traders. Or you meet some trader on Twitter. He's up 35% over the last 5 years. They call him a trader, like it's something that's bad. I got called a trader too. When I showed a video in 2022 of how I made 27%, mainly doing options and many different things, was buying stock. So they called me a trader and all kind of names. Instead of asking me what I did, instead of asking me what kind of things I looked for, how do I do the options I did, they were calling me a trader, like it's something that's bad. Instead of being open-minded, learning from each other, exploring different strategy, most investors are stuck in a bubble of their own, and they believe their strategy is the only strategy, and they judge and they make fun of everyone else that's different from their growth or value investment strategy. It's very wrong. If you have an open mind, you're going to learn a lot of different things, and you don't have to implement everything you learn. You could learn different things from growth investors, traders, and many others, and you can gain more knowledge, and you're going to know better of what your investment style actually is. And it's very important. So don't just go belong to a certain camp and then hate on other people. Be open-minded. If growth stocks are playing out, maybe you could find some undervalued growth stock. Maybe you're a growth investor, maybe you could find an undervalued value stock. It's very possible. So this is the first one. The second one is being scared of losing money. This is something I always say, is that if you're scared of losing money, you're going to lose money. And people don't really understand what I mean. Like, what do you mean? Well, this is something in the market where people, especially new investors, they're terrified of losing money. I don't know what it is, but maybe they heard the quote from Warren Buffett, rule number 1, never lose money. Rule number 2, never forget rule number 1. Yet Buffett himself, he lost money on airlines. He lost money on Paramount. And this is fine. This is okay because we all make mistakes. It's all about learning from them and moving on. You're never going to make money 100% of the time. And investing in stocks is not about never losing money, but it's about making more than you lose. This is what you have to understand. It's not about not losing money. It's about making more money than you actually lose. You're going to lose money. There's no way. If you want to pick stocks, you're going to lose money. But this is a big mistake and something huge that people recommend because they say, oh, if you don't want to lose money, you could just DCA, just dollar cost average down. And this is what it says. Investing smaller amounts regularly means less stress for investors. Stress? What do you mean by stress? Do you think Warren Buffett is stressed? Do you think Howard Marks is stressed if the price is going up and down? No, because they did the research, because they know the value of the stock. So you couldn't care less about the price because you understand the value. You buy and sell based off fundamentals, not based off your price. And you should not be stressed. If you're stressed as an investor, it's mainly because you haven't done enough research, so you don't have conviction, or maybe your position is too big and you need to reduce it. But I never heard these huge investors talking about dollar cost averaging. Even Buffett himself, he said you shouldn't own stocks if a 50% decrease in their value in a short period of time would cause you acute distress. You shouldn't even own stocks. But if you not want to be stressed, you have to do your research and understand the value of what you own. And sometimes it makes sense to sell the dip. This is what most people don't understand, is that DCA is an amazing strategy and it works on Apple, Google, the best companies, and it also works on index funds. But it doesn't work on every single stock. If your dollar cost average on Walgreens over the last 5 years, you lost a lot of money. Why did you dollar cost average? Because you did not want to take a loss. You wanted to reduce your loss to feel better. This comes all to the whole concept about being scared of losing money. If you're scared of losing money, you're going to lose money. That's how it is. Some stocks you should sell the dip on. I can make, an example. One stock I lost money on was Lumen. I sold Lumen at a loss. I lost like 8%. And I sold around $5 per share. Since I sold Lumen, it's down 79%. I sold Lumen because a new manager came in and I didn't like the way she was doing stuff. She wanted to invest in growth instead of paying down the debt. So it just wasn't my thesis. My thesis changed. I got out. Same thing with MP Materials, another stock I bought last year. I would have lost a lot of money. I bought it at 27. I sold around 24 or 25. But since I sold, the stock is down 48%. So sometimes if the thesis changes, you have to be able to take a loss, say you're wrong, admit you're wrong, take it on, and move on. Just move on. Don't look back to see if the stock went up to make sure that you did the right decision. Just don't even look at it. Just learn and move on. And it's fine. And if you're scared of losing money, you're going to lose money. That's how stock picking works. It's not about feelings, not about not wanting to make money all the time. The best investors don't make money all the time. So you don't have to be scared of losing money. Sometimes you win, sometimes you lose. As long as you're winning more than you're losing, that's all that matters. So this is the whole thing about being scared of losing money. The third one, which is my favorite one, and this is like the worst one ever, and it's mainly that investing in brands you love. It's really big. And this is pushed by mainstream media that you could invest in brands you love. Meaning, let's say you own a Tesla car. You love the car, it's an amazing car, you really like it, so you decide to invest in Tesla stock. And not because the stock makes sense, but because you love Tesla. That's really, really bad. Or because maybe you love Elon Musk. That's very, very bad. You invest in Tesla if Tesla stock can make you money. It's all, again, about making money. It's not about following narratives, not about growth or value investing. It's not about the brands that you love. It's about the brands that other people will love because they will buy the product, not you. This is where the sales come from. So let's say, for example, you like Pepsi. You decide to invest in Pepsi stock, not because you believe the stock is undervalued, not because you think it's going to make you money, but just because you like Pepsi yourself. Doesn't make sense. If you like Pepsi and you think the stock is undervalued, did your research, that's different. But you don't invest in brands that you love and you don't skip brands that you don't love. But it's because it's not about you. It's about other people. It's about other people buying stuff. That's how sales grow. It's not going to grow from you. And you just cannot just invest in brands that you love and ignore brands you don't love. That doesn't make sense. It's about other people, not yourself, and about stocks that could make you money, not stocks about, make you feel good and all these kind of things. Again, it's not about feelings. You're in the market to make money, and this is why you're in the market from the beginning. And you just don't have to forget it. The last one, which is, again, it's a big one, it's the most basic one, but looking at past performers. For example, I puts a stock on Twitter or on YouTube, they tell me over the last 10 years, the stock did nothing. You would have been better off owning the S&P 500. Who cares about the last 10 years? You have new managers that came in. You have something, maybe a new trend, maybe let's say something with nuclear stocks. You can have a lot more energy consumption from data centers. Who cares about the last 10 years? It's about the present and the future. Past performance has no guarantee of future results. If Apple went up 50% over the last 5 years, it doesn't mean it's a better stock than the a stock that was flat. You have to look, why is Apple up 50%? Why is this other stock been flat? And if there's something that changed in the company. Past performer has nothing to do about the company. It doesn't mean anything. It doesn't mean anything at all. We could have been in a mania and the stock is up so much. You would prefer it over the stock that was flat just because it went up. It doesn't make sense. It's not about the stock. It's about the value. It's about the fundamentals. It's not about the price. And it's something that's very important. And just to recap everything again, belonging to a certain camp is gonna keep you from learning a lot of stuff, a lot of important things from different people, and it's gonna keep you in a bubble and forget why you're in the market. You're in the market to make money, not to win arguments, not to follow narratives, not for being right. You're in the market to make money. Being scared of losing money is another one. Sometimes you're gonna lose, sometimes you win. And it's all about making more than you lose. The third one is investing in brands you love. You invest in stocks that make sense, not if you like or don't like something. It has nothing to do with it. And past performance has nothing to do about the present or the future or the company itself. So this is all I had to say. Not financial advice, just from my experience, big mistakes that stock market investors make, mainly beginners. Thank you again for watching, and I'll talk to you in another update.